So, in example A, YCO is a company resident in jurisdiction Y and is a CFC within a US MNE group. YCO licenses IP to XCO, a company resident in jurisdiction X, in return for royalties. The license is valid for a geographical region which includes jurisdiction X. In practice, XCO uses the IP only in jurisdiction X. Under the jurisdiction X tax law, outbound royalties paid by resident taxpayers are deemed to be sourced in jurisdiction X and are thus subject to royalty withholding tax. In this scenario, the jurisdiction X royalty withholding tax will not satisfy the source-based attribution test because the withholding tax is based on the residence of the payor, XCO. The proposed regulations introduce an exception called the single country exception to the source-based attribution test. The exception will apply if the taxpayer has a written license agreement that provides for the payment of the royalty and that limits the use of the intangible property giving rise to the royalty payment to the territory of the foreign country imposing the tax. Such a license is called a single country license. An important point to note is that the single country exception applies only for withholding tax on royalties. It does not apply to withholding tax on other outbound payments, such as service fees. Example B has the same facts as example A, except that there is a written license agreement which allows the use of the IP in jurisdiction X only. In this scenario, the license agreement is a single country license. Accordingly, the royalty withholding tax will satisfy the single country exception, and therefore it will satisfy the source-based attribution test.